You're listening to a production of the National Media Archive. To learn more or volunteer, go to nationalmediaarchive.com.
Picture this. It's a Friday afternoon in June 2008. Inside the towering offices of Lehman Brothers, a titan of Wall Street, the atmosphere is tense but outwardly confident. Their CEO, Dick Fuld, addresses staff worldwide. "Our firm is strong. We've survived storms before, and we'll do it again." But let me ask you what happens when the facade of confidence masks a crumbling foundation. Behind the scenes, Lehman's share price is in freefall, hemorrhaging millions by the minute. The technical terms here are liquidity crisis. That's when a firm can't get the cash it needs, and market confidence, the fragile belief that keeps banks afloat. Now you might be thinking, didn't anyone see the cracks? The answer is yes, but denial is a powerful force on Wall Street. Let's explore how it all unraveled. Ever wondered what a true financial emergency looks like? Let me tell you a story from September 2008. On a rainy Friday, the U.S. Treasury Secretary Hank Paulson calls an emergency meeting with the so-called masters of the universe, the heads of America's biggest banks. In finance, these meetings are called war rooms, and the main topic is due diligence, a technical term for scrutinizing a company's books. The conflict? Lehman Brothers is on the brink, and the government refuses to bail them out. Imagine being summoned to the Federal Reserve with no warning, knowing you might witness economic Armageddon. Now, you might ask, can a single weekend really change the world? Absolutely. This was the setup for a global financial earthquake. Who was the man at the center of this storm? Enter Dick Fuld, a driven, uncompromising CEO, often described as a Lehman lifer. He transformed Lehman from a traditional investment bank into a risk-taking juggernaut, chasing profits with relentless ambition. Here's a technical term: leverage, using borrowed money to amplify gains. Fuld loved leverage. Now, imagine an intern rising to command over 28, zero staff across 60 offices. That's the setup. The conflict? His iron grip stifled dissent and blinded him to risks. Inside the firm, people feared him. Some wouldn't even speak in the elevator. By the time the crisis hit, Fuld's vision had become Lehman's Achilles heel. The resolution? When your strength becomes your weakness, disaster isn't far behind. Let's break down the engine that powered Lehman's ascent and descent. Leverage. Leverage, in plain English, is like buying a house with a small down payment and a huge mortgage. If the house price goes up, you make a killing. If it falls, you're wiped out. Lehman's leverage ratio soared to 44, one meaning for every one of real capital, they borrowed 44. That's not just risky, that's reckless. The technical terms here? Collateralized debt obligations, complex bundles of loan sand, credit default swaps, insurance-like bets on defaults. These instruments multiplied both profits and risks. Now, you may wonder, didn't anyone warn them? They did, but in the boom times, warnings sound like pessimism. When leverage works, it's financial alchemy. When it doesn't, it's a house of cards. Let me paint you a picture. In the early 2000s, American homeownership was the dream. Banks handed out subprime mortgages loans to risky borrowers with little regard for their ability to repay. Heard of ninja loans? That's no income, no job, or assets. These were the seeds of disaster. Investment banks like Lehman packaged these mortgages into mortgage-backed securities. Think of them as bundles of risky loans, wrapped up to look safe. The setup: easy credit and rising house prices. The conflict: when rates rose, borrowers defaulted in droves. Suddenly, the supposedly safe investments were toxic. The lesson? When incentives reward risk-taking over responsibility, the entire system is vulnerable. So why did one bank's bankruptcy send shockwaves worldwide? It's all about systemic risk, the idea that one failure can topple the entire system. Lehman was entangled with countless banks and businesses through complex derivatives financial contracts whose value depends on other assets. When Lehman fell, no one knew who owed what to whom. Banks stopped lending, fearing hidden losses. This is called a credit freeze. Now, imagine waking up to find not just your bank, but your entire economy in jeopardy. The setup: interconnected global finance. The conflict: panic and mistrust. The resolution? Well, as we saw, solutions were slow and painful to arrive. Let's zoom in on the fateful weekend negotiations. As Lehman teetered, two potential saviors emerged: Bank of America and Barclays. The technical process here is due diligence, each buyer scrutinizing Lehman's books for hidden dangers. But as accountants uncovered massive losses, Bank of America bolted and Barclays hesitated, needing government guarantees. Now, you might ask, why didn't the government step in? Political pressures think moral hazard. The idea that bailouts encourage more risk loom large. The deals fell through, and by Sunday, Lehman was out of options. The lesson? In a crisis, trust, speed, and transparency are everything. Lose any, and rescue turns to ruin. How do rumors become reality in a crisis? Lehman CEO Dick Fuld blamed negative press for fueling a downward spiral. The technical term here is self-fulfilling prophecy when fear creates the very outcome it dreads. As the media reported plunging share prices and potential insolvency, investors and clients panicked, pulling their money out. It's a classic run on the bank. Now, you might be thinking, should the media have kept quiet? But transparency is key in free markets. The setup, swirling rumors, the conflict, loss of confidence, the resolution. Sometimes, the truth itself is destabilizing when the fundamentals are rotten. When Lehman finally filed for bankruptcy in the early hours of Monday, September 15th, 2008, it was the largest bankruptcy in history, 10 times bigger than Enron. The technical term counterparty risk suddenly became a household worry. If Lehman couldn't pay its debts, who else was exposed? Markets worldwide plunged. Within days, $700 billion was wiped from global stock indexes. Even non-financial companies struggled to make payroll as credit vanished. You might ask, was this inevitable? In hindsight, the system's complexity interconnectedness meant there were no easy exits. The shock was global and immediate. What did we learn from Lehman's fall? For starters, that unchecked greed and hubris's dangerous overconfidence can bring down even 158-year-old institutions. The technical fixes? Policymakers debated regulatory reform, stronger rules for leverage and risk-taking, and the creation of resolution authorities to wind down failing banks safely. But here's a question for you. Can rules ever fully tame human nature? The setup, a system built on trust and ambition. The conflict, ambition turns to excess. The resolution, only vigilance by regulators, investors, and the public can prevent history from repeating. Next time you hear about a financial miracle, remember, there's always a risk hiding beneath the surface.